Hello traders, in today's video we're going to be talking about move contracts once again. In a previous video I talked about how to take advantage of the arbitrage between the predicted expiration price and the traded price of move contracts. And in today's video we're going to be doing the same thing but the opposite. So let's dive in. In today's video we are going to be talking about how do you profit if there is a minimal difference between the predicted expiration price and the traded price. What do you do? Now, before I give the answer for that, or really the whole strategy of what I'm going to be talking about today, in a previous video, I had talked about how to profit when there is a large difference between the expiration price and the mark price. I'm first going to show how that works and how you can make money from that, and that's kind of like shorting a put or shorting a call. So the way that you would do that is if you notice that there's a pretty big difference between predicted expiry and mark, you would short the move contract, and then if the Bitcoin price is above the strike price, you would long BTC, and if Bitcoin price is below strike price, you would short BTC, and you would profit from price doing nothing with a drop in implied volatility, or from price moving farther away from its strike price. So that might be a little bit confusing at first, but if you want to go watch that video, I'm going to link it in the description below. That's what you do in that video if there's a big difference between predicted expiration price and the mark price. And there are a lot of ways to profit from that. But that's not the nature of today's video. Today's video, we're going to be talking about the opposite. What I had said before. Hey, Bennett, okay, I was like trying to simulate a question. Hey, Bennett, if the expiration price and the traded price are the exact same, how do I make money? What do I do? Well, anonymous user number 502, I'm here to answer that question. So I'm first going to actually ask it to you guys. If I was to give you access to long, short Bitcoin, you can go long or short in Bitcoin, great. And you can either buy or sell this move contract. What would you do if the predicted expiry price and the mark price were trading around the same? Okay? What would you do? How do you profit from this? All right, so the answer is this. If there's a minimal difference between the expiration price and the traded price of a move contract, you buy the move contract when the difference is low. And that might seem a little bit weird and counterintuitive, but let me explain. If BTC price is above strike price, you're going to short Bitcoin, and if BTC price is below strike price, you're going to long Bitcoin. Opposite of what we do here. Now, how do we profit from this kind of setup? Well, we're going to profit if a difference forms between the expiry price and traded price. So let's say that you buy a move contract at a price of 200, expiry price is 200. Let's say then Bitcoin, it's priced at 200 because Bitcoin is trading $200 above the current strike price of that move. Everything makes sense so far. What we would do in that situation is we would go short on Bitcoin and long on that move contract. The reason we do that is for every extra for every plus one that Bitcoin moves, we will just lose $1 from the short Bitcoin that we just did, but make $1 from the move contract that we went long on, right? But it gets better. If price is able to drop, you make a fair amount of money. And the reason you can make a fair amount of money from that is because if price begins to drop a bit, let's say that it drops from 200 above the strike price to only $50 above the strike price. The difference between the expiry price and the traded price is going to grow quite large because it's not like the move contract at that point is going to be trading at 50, right? The move contract will probably be trading at like 110, 120 when the expiry price is only 50. And this happens because there's still time left on the contract. And if that happens, that's awesome because all you'd have to do is just then sell the move contract for a slight loss and then get that huge gain from the Bitcoin short. That was a lot. That was even a lot for me, but that's kind of the strategy of this. But it's a lot easier to show visually, believe me. Okay, what I just said is okay, cool. But let's talk about this more visually. Just simply using this one that expires in 4 hours. So let's say we buy this guy at a price of 180, 185 or whatever it is. So if we buy that at a price of 180, we know that, what's the strike price on? Yeah, 10507, right? Mm-hmm. 10507. So if we were to buy that, then our payoff graph would look like that, right? With only 4 hours left in the contract, we have a pretty good payoff graph. But because Bitcoin price is currently below the strike price, we would go long on Bitcoin at current price, which is 10,320, because that's the rule here. If Bitcoin price is below strike price, you long Bitcoin and you buy the move contract if there's a minimal difference between the predicted expiry and the traded. Here's what your payoff graph would look like. If you went long there, boom, 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 boom. Your payoff graph would look like this. This is actually showing that there's an arbitrage profit, so I think that that's probably wrong. So I'm going to do 185 divided by 20,000. Yeah, you'd be buying it a little bit higher. Calculate wrong. Yeah, so this is what your... Oh, still an arbitrage profit. Oh, what a good play. So this is what your payoff graph would actually look like. I know this seems a little bit weird. You know, how is your payoff graph this good? But it is possible. Because all we're doing is we're buying the move contract at this price. And let me actually put in 185 as the simulated buy price because this still looks a little too good. Yep, 925. I just did that. So yeah, this is exactly what it would look like. But you might say, so this looks great, but if this contract expires in 4 hours and the price is at 10,320, the probability that price goes anywhere above like 10,550 is very low. It is very low, but that's not what you're profiting from. What you're profiting from is, let's say that the price of Bitcoin goes to 10,450. And when it goes to 10,450, there's still a difference between the predicted expiration price and the traded price of the contract. That difference is what we profit from, because that difference is where we want to sell the move contract and then sell our BTC long position. Okay? Because this payoff graph is only the payoff graph for expiry. But if there's time left on a contract, well then it won't look like this. It'll look a lot different. You know, because whenever the Bitcoin price goes back to the strike price, it's not like the move contract goes to zero. Almost never will it do that, because then everyone would just buy the move contract, right? And then infinite profit. Because if you buy it at zero, it's impossible for you to lose, near impossible for you to lose money, even after fees. So what's going to end up happening is, let's say that Bitcoin goes back to 10,500. Well, how much profit would we make? We would actually make more profit than this indicates if the contract hasn't expired yet. Because what would end up happening is the contract, let's say 2 hours out, is trading at 50. And let's say that our BTC long made us about 180, because that's 10,320 to 10.5, 180 buck profit. Awesome. And we bought this at 185, and now it's trading at 50. So that means that we lost $135 from the move contract, but we made 180 from the shorted, from the bought Bitcoin, giving us an arbitrage profit of about $45 per contract. Okay? That's probably one of the best scenarios. But then the final scenario that I'm going to talk about that with this strategy can be beautiful is if this happens. If price just like goes crazy, and goes crazy above the strike. And that's what I'm talking about here. You will profit from trading the difference between expiry and traded if there's a difference that begins to form. Because right now, guys, it's just the traded price is at 185. The expiry price is at 185. There is no difference. But as Bitcoin gets closer to the strike price, well, then guess what happens? A difference begins to form between the expiry price and the traded price. That's what you profit from. You profit from that because there's still, the contract is priced higher than it would be at expiration because there's implied volatility left on the contract. So that's one thing you can profit from just exiting both pre-expiry. But then the absolute best thing that can happen with this is if Bitcoin expires beyond the strike price in the other direction. Now, an example of this would be, imagine that Bitcoin just sails in the next 2 hours above 10,507.6. I'm talking it goes like 10.8. Well, then you would probably not want to just close them out, before expiry. You'd probably just want to let that expire at that point. Because if it goes all the way up to like 10.8, well, your profit is quite large, like 587, and your risk is minimal because after fees, you're probably only going to lose like $7-8 after fees, probably less, maybe like $10 after fees. So your risk is like $10, but your profit can be like 500. Okay, and just understand why this happens. We don't get these kinds of plays every single time. And the reason why this payoff is so good is because this contract expires in 4 hours. So no traders really believe that Bitcoin in 4 hours is going to be trading above 10,507. And because of that, this is underpriced. And because of that, the traded price and the expiration price on this contract is just about the same. Okay? So that is the strategy. I hope that kind of makes sense. Let me go back up to the explanation here. But to kind of reel us back about trading these move contracts, you can profit from a large difference between the predicted expiration price and the traded price, and you can profit from a minimal difference between the two. Now, whenever you're doing this, you are basically shorting a put or shorting a call. It's kind of the same thing. Not shorting a put and shorting a call is the same thing, but when you short a move contract and either buy or sell Bitcoin, that's basically shorting a put or shorting a call, and your payoff graph will reflect that. But when you profit from minimal difference between the expiry and the traded price on a move contract, you're basically buying a call or buying a put. And this is exactly what a lot of calls look like with their P&L graphs, except typically they're not as good because you're going to have, this would be down like here, okay? But I'm going to give one last example. Let's go on the daily. I think this is a great one. Oh, this is perfect. So I just taught you guys, hopefully you had before watching this video, hopefully you had just seen my profit from the difference between the predicted expiration price and traded price. And now I just taught you guys, hopefully, how to profit when there's a minimal difference between the predicted expiration price and the mark price. So my question to you is, what would you do in this situation? Would you rather treat this like try to arbitrage the difference between these two by shorting a move contract and then, where's the strike price, 10362, shorting a move contract and then let's say shorting a move contract and then that would be shorting BTC, or would you rather buy a move contract and buy BTC here? What do you think would be better? Well, there's no right answer for that because we can't predict the future. We can just take the best payoffs and probabilities that we have access to. But let's go simulate what would this look like? If we were to buy this contract at 90 and to also buy Bitcoin, how would that kind of look? Would it even be worth it? Well, that is what we are here to find out, ladies and gentlemen and bots. Okay, so to do that, I'm first going to put the strike price. Oh, nope, not you. Okay, you. Yep. And let's go put the strike price in, and then I'm also going to calculate what 90 is in prices of Bitcoin. So that's going to be 90 divided by 2 times the price of Bitcoin, so 90 times. Okay. So I'm going to get this for you guys soon. So if you were to buy this move contract, the daily move contract, right? And then you were also to buy Bitcoin at the current price of 10,320, let's go look at our payoff. So our payoff is decent. It's kind of bad, I guess. Basically, if price is above 10,400 in 4 hours, you make money. But if price is anywhere lower, then you lose money. So, but your payoff is your payoff's okay. I mean, it's just kind of unfortunate. This $47 loss is very likely to happen because price is more likely than not to stay below 10,380. But the benefit of this isn't trading it and then just hoping and then just waiting for it to expire. Again, the benefit of this is trading this and then getting out before it expires. That's really what I love to do whenever I buy calls or buy puts, or when I do like a synthetic put or synthetic call from this kind of strategy of profiting from the difference between these two. But in this case, the reason why this just looks like an overall bad play is because it is. I mean, I said there's no good or bad play on this, but this looks pretty bad. This expires in 3.5 hours, and your payoff's this. It's just not great. And the reason it's not great is because there's such a big difference between the expiration price and the traded price, right? Like, let's say that this guy was at 90, and then this was at 90. Well, that would be pretty easy to make money from. Because all I would do in that situation is just buy it at 90 here, and if it's trading below the strike price, I would just buy it, and then I would also buy BTC. And then for every price drop of $1 that price goes down, I lose $1 from my bought Bitcoin futures contract, of course, but then I make $1 because I bought the move contract. And then if price flips above the strike, then we make a fair amount of money, because if price flips above the strike, you're making money from the move contract and from the futures contract you bought. And if Bitcoin price goes back to the strike price and trades around there, then there's still going to be implied volatility left on the contract, which means that there will still be a price that's greater than the predicted expiration price. So I hope that this wasn't like super confusing. I know that this kind of topic isn't really the simplest topic. It's not like, RSI, Bollinger Bands, crossover, do this, do that. Here's what you do. Bye-bye. This is a little bit more advanced. But if you were able to stick with me for like the majority of it or have some more questions, then kudos to you. And if you're able to get it this far in the video without, I don't know, skipping around the video, well then also kudos to you. And if any of this doesn't make sense, I'd recommend you reach out to me, or you try to put it on paper and actually try to simulate these contracts, because that helped me so much. Is like a visual simulation, which is this guy right here. Visual simulations will help you just so much, okay? And if you want to know how to simulate a move contract and price it in Bitcoin, what I like to do is, okay, I don't want to, this is going to get a little bit more complex now. You put the strike price as it was on the move contract, and then whether you're selling or buying, you put the price that you bought or sold the move contract at, and then you divide that price by 2 times the current BTC price. I always use 10,000. Just trust me, just use 10,000 for this. So let's say that there's a move contract trading at 100. It would be 100 divided by 20,000, and then I would slot that number into here. 20,000 is what I divide by because it's 2 times 10,000. So that's what I would do here. So yeah, that would be great if I could. Oops, I don't know why you're there, bro. That would be great if I could sell. You know, like I could sell at 100. That'd be great. But yeah, so that's gonna be it for this video. I hope that this was helpful. I think that this really changed my trading because I actually just took a trade based on this, where what I found was I looked at a monthly contract and I saw that there wasn't that much difference between the predicted expiration price and the traded price. So I bought the move contract, and then I also bought Bitcoin to take advantage of the volatility still left on the contract and the time left on the contract. And if you want to know more about that trade I just took, I'm more than happy to share it in private messages and then go from there. So with that, I'm going to leave you guys with that there are 2 different ways you can profit from move contracts. If the difference between expiry and traded price is really high, or if there's no difference at all, you can profit from either. And I think it's pretty intuitive. And with that, happy trading, and I'll see you guys later.